Good morning and welcome to the final balanced perspective of 2022. As usual, I'm your host, David Levinson of Net Group Investments. And we're joined via video from Johannesburg by Iain Power, the CIO of Truffle Asset Management. Iain, for the final time this year, thanks for joining us.
Hi, David, and good morning to everyone signing in on the call.
For those with an eagle eye, will notice a couple of things. I'm sporting a sharp new haircut that makes me look like an English Premiership footballer. I'm also wearing my chino, so not full suit and tie today. I'm in December wind down mode, but unfortunately the markets seem to have missed that memo. It's been quite a volatile time. We are being hit with local and international news from the right and from the left. But today I'd like to focus not so much on the left or the right, but what's in front of us as we move forward into 2023. So as always, we're going to lean a lot on Iain and his deep and broad knowledge base here. Iain, to bring you off on the first question, it's going to be a little bit different to previous sessions, a little bit more quick-fire, kind of briefer answers, and a broader array of questions, if you will, because we've covered such a significant amount if I reflect on the last 10 balanced perspectives we've had this year. So while the last quarter looks set to deliver actually quite strong and robust GDP, or at least economic growth, the forecasts for next year are a little bit more tempered, so growth is expected to slow. But we're also obviously experiencing high rates of inflation and an interest rate cycle that it looks like central banks will be continuing to up rates, although apparently by smaller increments, maybe with even higher frequency. So against this backdrop, what is your view for global equities as we go throughout 2023, given a relatively low base?
Yeah, David, you're right. So I think we're going to see the effects of the tighter monetary policy start to flow through into the real economy next year. And we know that there's sort of, anywhere between a 8 and 12-month lag between interest rate, monetary policy and rate hikes. And, depending on the speed of those rate hikes, you can also have, accelerated impacts on the economy. So I think if we sort of look at that and take a step back, I think it'll be no surprise that, as you've said, growth is going to slow. And I think, UK, Europe probably will be in a recession earlier. And then more likely the US joining them in the latter half of 23. And that really just is a reaction and the economy adjusting to the higher cost of capital. And I think that then really sows the seeds from an equity market point of view for what, we think is probably going to be a disappointing year from an earnings point of view. So we've seen markets come off already. Certainly, if we just look at the US from their highs and multiples, if you just look back and compare the S&P 500 versus its history, it's sort of close to fair, but it's not pricing in any earnings decline or any earnings compression. If you just compare that to Europe, for example, where European equities versus their history are pricing in a reasonable hit to earnings. So we think earnings probably come under pressure, and that'll be a headwind for markets. However, in the shorter term, as you've said, we could see some knee-jerk reactions as people start to view the US getting towards the end of its rate hike cycle, and those headwinds of then interest rates, perhaps people starting to take a view as to when the Fed may look to cut. But I think before we get there, we got to see the impact on earnings, and we think that's probably likely to be, reasonably negative, which is going to mean that, equities have still got a headwind, certainly from a US point of view into next year. And I think I would add to that statement by saying in US assets, we also think that the dollar is pretty much, rolling, or we've seen the best in the dollar. So I think from a sort of a trade-weighted perspective, if you look at the returns from US assets, we think that those returns look quite dim versus perhaps some other geographies around the world where, currencies are a lot cheaper and where the underlying base values of markets are a lot cheaper. So that's definitely not a place that we would think, you want to go looking for value.
Okay. And also, I guess on the economic news front, the employment numbers out of the US came out surprisingly quite robust last week there. Shifting a little bit now to the conflict in Ukraine. Who would have thought, almost a year later, we're still talking about this. The US reckon that the war will be reduced, or at least will continue at a reduced tempo for some months to come. But it's also the humanitarian effects of war aside, it's very much also been a war about energy. And we heard last week the G7 and the European Union limiting the purchase price of Russian oil at around $60 a barrel. There's been a bit of an oil response recently. So I just want to get your sense, do you agree with that US statement around a more prolonged but lower tempo war? And then you've also put forward the idea of high energy prices for longer. Does this support that thesis and feed through into how you position your portfolio?
Yeah. So, I mean, I think if we look at the conflict between Ukraine and Russia, there seems to be little appetite for some sort of discussions, certainly from the Ukrainian perspective, just because the Russians can't be trusted. But what we are starting to see, and I think we'll probably see more of it as we go into the European winter, is we'll start to see more and more reaction from Europeans, voters in Europe, in other countries, Germany, Italy, for example, who are saying that, well, you know, the cost of this war and this engagement is really being felt by European consumers, largely, you know, to the extent that US consumers are you know, not in the same position to the extent of energy prices. And I think you're starting to see, you know, signs of pressure building. And yeah, I mean, I think it's, you know, to say that this thing will continue indefinitely, I think is, you know, as we sort of stand today, looks like a sort of a base case view. But I think from a political point of view, voters are starting to feel pain, and they're letting that pain be known, and it's starting to flow through back into the respective government. So I think, you know, the pressures for some sort of settlement or some sort of discussion or ceasefire are going to start to build. Whether that actually culminates in something that's real, something that is sustainable, because, you know, the Russians really have not been trustworthy or can't be relied upon to act in terms of what they say, you know, remains to be seen. But I think you can already see around the fringes that is starting to build. And I think, you know, on top of the deficit in terms of investment into fossil fuels, you've got this conflict which is exacerbating you know, European consumers' position when it comes to affording energy. And, you know, it's one thing to support a conflict that's very far away and out of sight and out of mind. It's another thing when your energy and heating bills gone up 4 times. And that's impacting, you know, logistics, supply chain, food costs, etc. So I think we're going to start to see what we must expect is we're going to start to hear more noise and more pressure from some of the hardliners in Europe to say, listen, you know, maybe we need to make a deal here. Obviously, the Ukrainians don't want to have anything to do with it. And if I was in Sweden and Scandinavia, I wouldn't either. Because, you know, those are the guys that are right on the border of Russia. So I think it's going to be interesting. So, you know, probably means volatility stays high. And certainly we think from an energy point of view, you know, there's the lack of investment in many of the fossil fuel energies will continue to keep prices elevated. You know, as demand or price elasticity for fossil fuels remains relatively low. And we're going to see China start to recover into 2023, which is going to come online and start to require quite a lot of energy for its own recovery, which I think will sort of keep up energy prices. So, I mean, as you know, our portfolios have got a lot of these energy positions in place. They've done very well for us. And we still think that they look fairly compelling and cheap, you know, notwithstanding the fact that they're up 30-40%.
Okay, I'd like to come back to China in a minute, but firstly, there's been this interesting tension with the conflict. Obviously, a lot of European countries are turning on the old coal-fired power stations again, supporting the price of fossil fuels, but at the same time, this has also expedited their renewables program as well. We had, you know, COP27 in Sharm el-Sheikh in Egypt a couple of weeks ago. A lot of people leave those meetings slightly disappointed. Nothing has necessarily been agreed. All this money has been promised by the traditional north to southern and developing countries. South Africa included is due to receive a significant amount, I believe, to transition our energy system here in SA. Is there an investment proposition in there somewhere locally, or are you a little bit more skeptical that 2023 will see any value unlock?
No, I think that the pressure continues to build, and I mean both our own inability to generate consistent energy or have grid uptime, I think, is keeping the pressure going. And I think, we've seen in the newspapers, there's obviously a tussle between National Treasury and Eskom in terms of money for diesel, etc. But I mean, I think the bottom line is that the pressure on the state to deliver in terms of deregulation, in terms of accelerating RPPs, it continues to build. And I mean, we were just, we spent the last week with most of SA big corporates talking to them, just getting updates from lots of these companies. And it's interesting when you hear how fast they can bring some of these solar projects online, smaller scale, sort of 40 to 50 megawatts, but, able to bring it online in under a year. So I think the ability to bring solutions to the table is there. We just need enough pressure for, government to finally, cut those invisible barriers, or I guess the reluctance to embrace the renewables, which we think will give the SA economy then room to grow, because at the moment our growth is being constrained. And I think if we're lucky next year, we're going to manage 1% GDP growth. I think we'll be lucky to sort of get that. So I think, a crisis often brings solutions and change. And the question is the crisis, has it been enough? Has it been severe enough? And I suppose we'll only know that going into 2024 elections and see the outcome of what the ANC manages to get in terms of its support for its party.
Okay, and eventually moving to China, it's been quite an intriguing one for investors. If I rewind, a year or so ago, it was all about shared prosperity, clamping down a little bit on some of the tech companies and the education system there. More recently, it's been around zero COVID, and again, also fascinating to watch the social unrest there, and actually kicked a bit of change into the policies around zero COVID there. Coming off a relatively low base, I think the Hang Seng was actually up 6.5% in the last month. I think it's one of its biggest, best performing months in a couple of decades. So on the back of this, we've spoken about, the Pride Chinese Communist Party looking to kickstart growth again up to, 7.5% where they've typically been. Are you relatively bullish on China equities going into 2023?
So I think the first thing to say is that you're right, the pressure has got to levels which are untenable for the population. And I guess that conflict between the state and the population spilling over into media and what we've seen. But I think the big problem for China is still that you've got, sort of 300 million people who are over the age of 65 and have not had all their COVID shots. And there's a reluctance of the older people to be vaccinated. And if you look at the stats in terms of mortalities elsewhere in the rest of the world, the problem is China doesn't have enough ICU beds. So they sort of got this problem that they're juggling with, that their economy is really struggling and is, in some parts of it are imploding. You've got social unrest as well. And then on the other hand, they know that if they open up too quickly, you potentially can be looking at 20 million dead people. So I think it's a difficult one, and I think the only solution really is to accelerate and make vaccination mandatory, which they so far have not done. And I think we'll watch that. But I think your sort of comments are right, is that we've seen the worst and that China is likely to incrementally get better, although it's probably going to be a lot of stop-start. And I think at the moment what we're seeing is a lot of talk. And probably through into the Northern Hemisphere winter, we're not going to see a lot of action yet. But the talk is what the market is focusing on. And I think it is fair to say that, 12 months from now, this time next year, China is probably in a much better place. And I think a lot of those equities will start to discount better economic prospects, some of them which have already started to do so. And, therein lies some opportunities as well. In terms of allocating capital, to some of these opportunities. I mean, having said that, we also need to just frame China's support with Russia. And, to the extent that, Russia engaged Ukraine, we saw there was a digital repricing of those Russian assets pretty much to zero. So, investing in some of these Chinese assets is not without risk. And Xi has taken a more aggressive line with respect to the West, and he's made clear his policies and his intentions about Taiwan. And, one needs to put all of those things into your, I guess, assumptions when you're looking at what exposures to take and how much to take in your portfolio. But I think it is fair to say that, we've probably seen the worst, and things are going to slowly get better. And it's actually good for a country like South Africa because, we're very much an open-based economy. We need resources, and, China's effectively been in this state of lockdown now for, way too long.
It's interesting you mentioned the aging population there. I believe India is due to take over as the world's most populous country by April next year. So maybe the those that are proud might not be willing to give it that mental piece too quickly.
Well, that's right, David, you're right. But I mean, the other thing is, and we'll only see it, I guess, in the next, 12, 18 months. But there's a lot of talk that birth rates have plummeted during these lockdowns. I mean, you can imagine, people fearful, people worried about the future. So I think, they've probably punched another massive hole in their demographic by making people, the average Chinese person, just fearful about the future, and compounding some of these long structural problems now that are starting to position themselves squarely in front of the Chinese Communist Party.
That is in spite of dropping the one-child policy, I
Correct.
think up to a three-child policy as well. So we are slightly going over time. Please do bear with us. Humor us for the final balanced perspective of the year. The next one I want to speak to you about, I'm going to steal a term from The Economist called revenge tourism. They cited flights in 2019 pre-pandemic were around 1.8 billion tourist trips. 2023 is forecast to get close to there, to about 1.6 or so. I have siblings in the US I haven't seen since 2019, so I'm going to be eating bread and jam sandwiches to save up for the expensive flights that we have these days. But from an investment proposition, do you see this unwind happening, and are you keeping your eye on certain stocks? I know historically you have held the likes of Booking.com, etc.
Yeah. No, I think you're right. I think we're going to see a sharp decline in the spend on goods as people pivot towards services and experiences again. And, the one thing when you've been locked up, particularly in China for 2 years, I'm pretty sure the first thing those guys who are able to do so will want to get out of China and get to someplace warm and someplace less hostile. And I would expect that there's lots of money that has been saved, and there's going to be lots of spending. So I think from a sort of a tourist perspective, particularly the higher LSM individuals, we are seeing very little evidence that the current economic circumstances and interest rates are affecting their spend at all. Waiting lists for private planes, for yachts, luxury goods, I mean, it's never been as good as it is, yet the bottom end is in a whole world of pain. So I think a big dislocation in terms of spending ability with discretionary income between people who have a lot of money and people who don't. And I'm pretty sure we're going to see that come through in those respective companies who, either offer flights or services or sell, food or luxury goods to many of these consumers who have been, trapped in their flats for the last 2 years. So I think there is a boom coming, a bit of a boom for the travel sector.
Which is obviously good news for SA tourism, given our wonderful resources here. But as you say, the high cost of travel are burning a hole in all of our wallets. Last question, just need one or two word answer. Is the world and Iain Power ready for Trump 2.0 in 2023?
Definitely not. I would be horrified if we had to deal with Putin, Trump, what's going on domestically. I mean, we really do find ourselves in interesting times, but I'm hoping that, Trump has made enough of a damaging situation of his own Mar-a-Lago key confidential reports and God knows what that he's had around him to sort of literally take him off the table. And I also think that the recent performance of the midterm elections, where, if history is anything to go by, you would have seen a change in terms of leadership. I think the Democrats did surprisingly well. And I mean, maybe Wade versus Roe had a lot to do with that. But certainly I would think that some of the Trump-endorsed candidates didn't do as well as what they thought. And I think what you're starting to see in the Republicans is pretty similar to what we've got in our own ANC, which is a lot of infighting and backstabbing taking place now. So let's hope that that keeps Trump out of the running into the next election.
Yeah, and maybe you brought up something which is obviously can't ignore. The big elephant in the room is everything going on currently here in SA with Cyril and potentially a rudderless government. Does that concern you in terms of South Africa's economic prospects and the performance of our private sector?
Yeah, I think, look, we obviously all live here, so we know the issues that we're dealing with. But I think the big worry typically for markets is not so much something that's not sustainable, because we can see the current ANC policies and I guess their ability to deliver services is not sustainable, and we know they're going to lose a lot of share. But if you have big violent upheavals, there are always chances that you get unintended outcomes. And I guess those are the things that will make markets and people a little bit more afraid. So to the extent of succession planning, to the extent of opportunistic factions thinking that this is an opportunity to step up. And I always like to think about the analogy of like a big lion in the in the sort of the prime of its life. No one's going to challenge that lion. But if that lion looks to be a little bit weakened, maybe then there's a chance someone's going to come from the side. And I mean, typically markets don't like that. So I think, it's really about something that should be well telegraphed and, from a succession perspective. And I think that's what the ANC is now trying to do. I think they're sort of fighting for their own life. But from a country point of view, without a doubt, the ANC is going to lose a huge amount of support into the next election. And, we can look forward to some sort of coalition government and, ultimately more people sitting around the table who are accountable for public finances, which I think is going to be a good thing. But it is going to be volatile, and ultimately that creates opportunities.
I'm going to steal a quote here, which for those that have dialed in to take home with them, and again, apologies for going completely over time this morning. I read this in an article yesterday about diversify boldly, construct robust portfolios that will survive most scenarios. And I think Iain and his team have been relatively successful at doing that. So thank you, Iain. It's also a bit of a heavy heart today. I think this is potentially the final balanced perspective that I'll be hosting. I'll be passing on to a much wiser, intelligent, articulate and better looking colleague from next year. So it's been a wonderful, Iain, what has it been, 2.5 year journey you and I have been having these sessions?
It's been great. And David, well done. I think, you've been a great, I guess, host and interrogator and, question poser. So I think it's really gone well. And I'm looking forward to your colleague stepping into some big boots.
Okay, thanks, Iain. I feel like we should send each other a bottle of wine or a bouquet of flowers or something. But to give the audience context,
I've already got mine from you.
Okay. When we first started hosting these sessions, it used to be a long email between myself and Iain, the questions laid out, and I think over the last sort of year, it's more just a WhatsApp saying what we're discussing. It'll be climate change, Sasol, Eskom, and we kind of work off that. And Iain's got such a wealth of knowledge to draw on that he doesn't do any prep, and I can't seem to catch him off guard despite my best attempts. So from myself and Iain, thanks again for joining us today. Apologies again for going over time, and have a wonderful festive break. And Iain and my colleague Mansour will catch up with you in 2023. Take care.